Okay, recording has started. Good afternoon, everybody. Okay, welcome to this class of healthcare accounting and finance. Okay, we will start with this chapter, capital budgeting and investment decisions. Now, before we start, I just want to ask you: do you all have any question you want to ask me now? Anybody got any question? No? Okay. Next, I will ask you, have you do your coursework and submitted to me already? Because the deadline is actually 20th, right? And today is 28th. So please submit if you have not done. Okay? So we will start with this one first. Okay, so the title of today, first chapter is capital budgeting and investment decisions. So we are talking about 1, 2, 3, 4 subtopic. First one is time value, then evaluation technique, capital project selection in hospital, risk analysis for long-term investment. So we do the first one, which is the time value of money. So normally we call this TVM, time value of money. Now, what does that mean? It's actually a foundational concept whereby time has got value. Let's say, for example, you have 100 ringgit in your wallet now. So if you put the money in your wallet and you don't touch it, at the end of 1 year, it still remains the same 100 ringgit. But if you have take the money and you put it into a bank to get some interest, let's say the interest is maybe 1%, example. So at the end of 1 year, you get 101. What does that mean? It means 101 1 year from now in 2027. 101 ringgit in year 2027 is equal to 100 ringgit now. That's the concept of time value of money. If you do nothing with the money, you just keep it in your wallet, well, basically has no value. It remains the same. The value remains the same as 100. But if you have done something to it, you may have get some saving interest, or you may have invested somewhere and you get a return. So the return plus the principal of 100 1 year from now is equivalent to 100 now. Okay, so it sets a principle to understand how this time value of money theory will now influence you when you talk about investment decisions. So we look at the first one, which is called compounding. A present sum of money right now, a present sum. Let's say right now, your present sum is 5,000. It will grow over time when invested at a given interest rate. So you put the money at the bank. Okay, if the interest rate is 5%, it grows, it compounds. So let's look carefully. You start with the year at 5,000. Now, after 1 year, if the interest is 5%, 5% of 5,000, you get 5,250. So at the end of year 1, you get 5,250. Now, you have two ways of looking. One way is called a simple interest rate calculation, and the other is called compounding. Now, let's look carefully. In the second year, you have saved, and this amount, the same amount, 5250, is reinvested at 5%. If it's reinvested at 5%, you get 5512 because it's 5% on 5250. But if it's simple interest, you get only 250. Okay, so what's the difference? The 1250 is the compounding impact. Now, what happened? Why here you get only 5500? So you get an extra 250 from here. You get an extra 250. You get an extra 250. You get extra 250. So you keep on getting 250. Okay, every year you get 250. Simple interest. If you have not touched it, you let the 250. Now it's investing on 5% to 250, you get 512. And then you invest another 5% on this 512, you will get 788. Okay, so that is called compounding. So if you look after 5 years, maybe $130, right? 131. Okay. Oh, small amount, sir. Not so big. But if you're talking about 5 years, what about you're talking about 30 years? What about you talking about 30 years? Now, in Malaysia, we have a thing called EPF, Employee Provident Fund. Maybe your country may be different name. In India, they also have the word called EPF, Employment Provident Fund. In Singapore, they have a CPF. We call it a Central Provident Fund. It works on the compounding. Okay, now, when you work on compounding, the amount becomes huge, more and more huge, because the annual growth is different. So the magic of compounding is you don't touch it. And you keep on, whatever you have, keep on reinvesting again. Only problem is that can you have always 5% year in, year out for the next many years? Maybe you cannot. Right? Very seldom you will have maybe a 20 years or 30 years, every year you get 5% fixed rate. Unless it is have a contractual amount with the bank. Or maybe this amount was not put in the bank, it's put into can somebody off their mic because we will hear echo? Okay. So that's the problem. But if you can get 5%, this will be the amount. So you can understand now the impact of compounding is very much compared with a simple interest. Okay. So future value, exactly what it means. What is the future, the value in the future of a current asset? What is the current asset? Now, at the future date, 5 years or 6 years from now, based on the assumed growth rate, the interest rate, this is a formula. Okay, this is a formula. So it's difficult to take a piece of paper and write. So we use Excel. Okay, what is the future value if we invest $1,000 now for 10 years as the interest rate of 10%? So if we use the Excel formula, if you go to Excel, okay, you go to formula, right? You can get this kind of calculation. Future value. Key in the figure, press enter, you get this amount. Let's look at it. Where to get the formula? Excel? Oh, what am I doing? Can you see? Where's financial? Formula, financial. And you can see future value. and they ask you to put in the figures. Okay, so this is the same as here. Put in the 0.10 is 10%. The year, 0 payment, minus, because this is the first year you put in, it is a minus to you. Okay, because you're investing money, it's a minus to you, and you press calculate, it will come out this figure. Or you can use a financial calculator. This is an app you can download. Download this app, financial calculator, select TVM at the top left corner, key in minus present value, annual rate 10%, period 10 year, select compounding annually. Please, I don't want you to select monthly. Select money, the figure is different. Press future value, you'll come out to this amount. Now, what's the purpose of calculating this? It will let you know if you leave your money in a certain project or in a bank, at the end of a certain amount of years, at a certain interest rate, you will know what you get in the future. You can also use it, for example, in insurance, right? So if you invest a lump sum now, and the insurance company say, yeah, we'll give you 2% or 3% for the next 20 years, right? You press and you will get what should be the amount you will receive for your insurance. Okay. For example, term life insurance. Okay, term life insurance offered by insurance company. Now, if I do the reverse, okay, if I do the reverse, this will be the formula, and we call it the present value. Okay, future cash flow in all the various years in the future must be discounted to reflect their value in today's dollar. This principle is the opposite of compounding. It acknowledges that a dollar received in the future is worth less than a dollar today. Look carefully. A dollar received in the future is actually less than a dollar today. What does that mean? $10 in the future maybe is equivalent to $1 now. If I invest $1 now at a certain percentage for certain years, I get $10 in the future. But that $10 in the future is actually equivalent to $1 now. Okay, based on the number of years I invest and based on the interest rate. So that's the idea of present value. And you can also use PV to calculate. Formula, financial, PV. Okay, so you know, fill up, and then you can get it. Okay, you can also get this present value based on using the app. So what's the present value if you want 2593 in 10 years time at the interest of 10%? So let's say, for example, in 10 years time, I want this money for my son education. So I want to have a certain amount of money for my son education. He's now 10 years old. 10 years from now, he's 20 years. So when he's 20 years old, 10 years from now, I must invest a certain amount, okay? And I want to invest maybe 30,000 or 2,593. So what should I be looking for? I should be looking for, if the bank tells me I can get 10%, and if I'm not touching it for 10 years, I should invest 1K now. That's how you use present value. You want to reserve some money, okay, in a certain amount of time, in a certain amount of rate that a bank give you, or the investment portfolio will give you, or a dividend will give you. So how much must you invest now? So that's how you use present value. So basically, Future value and present value, they are just opposite each other. Future value is today I invest, how much I get in 10 years' time. That's future value. Present value is this the amount that I want in the future, how much I invest now. Okay? Now, when you talk about interest rate, okay, it can be compounded. If it's, they only pay you the interest at the end of the year, so for example, it's 5%. But if they pay you quarterly, so every quarter they pay you interest rate, okay, it will be 5.09. If it's every day paying you, it's 5.13. So if you can get a bank that paying you daily or quarterly, of course, it's better than annual. But most banks won't do. Most banks will only set you an interest rate annually. But if you are that lucky, then it's okay. So now we understand this technique of time value of money. Basically, money will be affected by time and also affected by the interest rate. How long you invest? What is the interest rate that you have? Using this theory, we will look at the evaluation technique. So in this particular session, we are looking at appraisal method, okay, to prepare you for investment alternative. Just now, so far, I just told you, well, okay, 1,000, you just invest in the bank, right? It's just to highlight you the theory of time value of money. We will now look more detailed when you're in the business. We will look at, sometimes we have a lot of alternate investment. For example, you're in the hospitality business, okay, healthcare. Do you want to buy a new MRI machine? Or should you want to open a new X-ray machine? Which is better? So we use this concept to help you to decide which is a better machine to invest. So now we change a little bit. We call it the MPV. This is the most popular way to evaluate, okay, investment. Net present value, NPV, whether a project investment will be profitable by comparing today's value of cash flow to its cost. In general, projects with a positive NPV are worth undertaking, while those with a negative NPV are not. So if capital investment, NPV capital investment, plus, which is normally a minus sign, because you come out the money first, plus cash flow, year one, divided by 1 plus R rate year one, until maybe you say 10 years or 20 years or 30 years. Now, in many, many projects, we don't use to calculate up to 100 years. So normally we will say we will only calculate up to 5 or 6 years. Because anything that is above 5, 6 years is hard to forecast. Now, under initial investment is easy. It's now. You will know how much you spend. But how much money coming in back? I'm not talking about profit. I'm talking about cash flow. Cash flow means how much I pay out cash and how much I receive cash. So if you are in a hospital, right, this is the initial investment on the MRI machine, minus 1 million. And from that MRI machine, minus 1 million, every year, how much I get in charging the services of the MRI to the patient. So 1 year, how much? 1 year, how much? The cash flow. So it's difficult to forecast for more than 5, 6 years. You can, but it will not be very accurate. So normally we will do maybe 5 years, 6 years to see whether we can recover our investment. So it is a minus sign, and each one of them is a few sign. So let's say here's 100 lah, another 100 lah, another 100 lah, right? But you must remember, the first 100 will be reduced by this rate. The second 100 will be reduced by this rate to the power of the second year. So why do you want to have a power of second year? Because power of second year is compounding already in the negative way. Because whatever money you receive here, let's say for example, If you receive here 110, it's equal to 100 here. How do you do that? Because you compound here 10. If you receive here 100, maybe it's only worth 90, because here is same rate, but 2 times compounding, 2 years. Okay, so how does that work? We will use Excel again. Let's say now, let's look at cash flow. We have a cash flow of, we minus out, we pay out 1,000, and then we receive 100, 200, 300. Every year we receive certain amount of money. Now, some year can be a minus sign, it doesn't matter, okay? If it's a minus sign, I'm talking about cash flow. And I think if I want to invest 1,000, I want to have a profit of 10%, minimum, okay? Minimum 10%, or this is the bank borrowing rate. Now, I don't have 1,000, I go to the bank to borrow. The bank will charge me an interest rate. So this can be the rate in the bank. Now, what's the present value? Can you see? 1 plus 1. Can you see? You can see the formula. B1, 1 plus B1, 1.1, 1.1, 1.1, A5. Okay? Year 1, year 2, year 3, year 4, year 5. Then you calculate, you will get 65.26. This is the total if you calculate all this amount. Okay. Now, when you go to Excel, it shows a little bit different figure. Why does it show a little bit different figure? Now, 65.26, how does it get? Here, minus C9 plus minus, so it become a minus of this amount. This amount plus, it will go back to 65.26. But Excel is a little bit different because of the decimal places. Okay, it's a big impact one. So anyway, what should you take? You can either take this. Sometimes there's not so much difference. Okay, this is a very bad example. Okay, but you can always use this cell. Okay, so what does that mean? If I invest 1,000 minus, okay, and the bank is charging me a loan of 10%. With this investment, I get this kind of cash flow. But after discounting, it's a different amount. You see, it becomes lesser. Because $500 is only worth 310 now. 500 in year 5 is equal to 310 now. Okay? So you will get this present value. You say, hey, sir, why don't we forget about all this? Why don't we just take this figure? Let's look at this figure. 500, 400, 900. Well, 900 is how much again? 1,002, 1,003, 1,004, 1,005. Okay? So if this is 1,005 and this, I should have a profit of 500. Now, in your accounts, you will show a profit for 500. Okay? In your accounts, you show 500. Because you add out all this, right? Minus 1,000 is 500 in your accounts. But in terms of cash flow, it's only 60 bucks. So how do we reconcile? We don't reconcile because we're talking about different issues. Okay? Accounting will show in numbers, you make a profit of 500. Fine. But that 500 is not worth 500 today. That 500 is spread over 5 years. If you want to know when we receive this money in the various time frame in the future, what is it worth today? 65. And then if you normally this is a plus sign, go ahead. You understand? If normally this is a plus sign, it is okay. If it's not a plus sign, it's not a good thing. Now, why you do this one? Because this is one example of a MRI machine. You will do another example for X-ray machine. And then you can compare what's the total amount of these two amounts. Okay, compare the total of these two amounts, whichever is better. That is the normal, most popular way to do investment appraisal to know which is better. You see, this is the MRI machine. It has got 1,000, it got 10% and 5 years. You may have another investment, X-ray, maybe a different amount, maybe 2,000. And the flow is not like that. The flow may be 500 first, then 400, and 300, 200, 100. The flow is different. And the rate may be different. So when you have two machines or two investment alternatives, which you think is better? Accounting profit will tell you what is the amount. Cash flow will tell you a different thinking based on the time value of money concept. Now, if you are an investor, which method should you use? Looking at the accounting profit or looking at the MPV? The answer is looking at MPV. Why? Okay, why is MPV more interesting? Let's look at this. Okay, let's say, for example, let's make it bigger. Oh, it's too big. Hang on. Okay, let's say we have two type of machine. So year 0, year 1, year 2, year 3, year 4, year 5. Okay, and for this one, forget about interest rate. You're going to invest 1,000. Two set of machine, two set of investment. Maybe this is MRI. Okay, and this is X-ray. Okay. Now, let's look at it carefully. Now, this machine is giving you the return of cash flow. So, what is the net amount? $500. But let's say this one is different. Notice the net is the same, but the timing is different. Correct? The timing is different. This is years. Hang on. If I'm going to invest 1,000, I will prefer this way because I get back money first. My exposure after 1 year is only 500. My exposure after this one is 900. The risk is different. At the end of the day, accounting accumulated profit is 500. But from risk point of view, which is more risky? This is more risky. Why? Because after year 1, I have spent 1,000, but after year 1, I only get 100. I'm still risky by 900. How about here? My risk right now is only 500, not 900 compared to here. Can you understand? Of the risk, and now the risk has been captured by the concept of net present value, which actually comes from the concept of time value of money. Is that understood?
Yes,
is that
sir.
understood?
Yes, yes.
Where is Angeline? Angeline, you're supposed to be the class monitor. You're supposed to answer. Anybody not sure? You understand what I'm saying?
Yes, sir.
No issue?
Yes, sir. Yes, sir.
Okay, now you can take this example and then put into your calculator and then you can see. Okay? Where am I now? Now, this is an Excel formula to calculate. Wait. Now, the next topic is called the internal rate of return. Internal rate is equal to MPV, but they also give you the percentage of the return. Now, here, okay, net account is different. It's a profit accounting. This is the profit based on accounting. Okay. The MPV is another calculation. You can use the formula or whatever. You can use the app. And the IRR is actually the percentage. This is the amount, and this amount represent what percentage. And this percentage by right should be higher than whatever percentage you use. If it's 10%, if you're using 10% to calculate the MPV, this IRR, if it's a positive, it would be a plus amount. Now, why do people still use MPV? Because they want to see the percentage, and this is the amount. The net MPV amount is the one that is the important one, the total amount. Okay, you can also use IRR, but they are the same thing. It's just that one is represented by numbers, and the other is represented by percentage. Okay. So this is the formula for it. Okay. So you can also use, if you use Excel, you come to equal to IRR. Okay. Then you can calculate this one. Okay. Hang on. So you got MPV, also you can use the formula. Okay. You can use the formula. And for the internal rate of return, also you can use formula. Okay. Excel. Because calculating in your head are very difficult. Now, you can also use, I didn't show here. You can also use the what? Here. Don't select TVM, select MPV. Okay, select MPV. First line 0 is a minus 1,000, and then you have every line you can key in the return of the cash flow. You need extra line, you press extra line, add in the line in the app, and then you can press, it will come out for you the MPV at IRR. Okay. I didn't show here, never mind. Okay, now, so far, what have we learned? We have learned the MPV method. Okay, and we have learned the IRR method. IRR, again, I repeat, it's just a percentage. It's a percentage representative of the MPV. Whichever alternative of investment you have, when you're comparing different investment opportunity, you use the MPV. The one with the highest amount MPV is the one that you can claim. Now, MPV is difficult to explain to non-financial people because you have to explain the time value of money. Okay, so we have another way to explain. It's not accurate. Okay, MPV is the most accurate. Another way to explain is called a payback. It's a very simple method. It times for the cumulative undiscounted cash flow to equal to the initial investment. How fast can the money get back to cover? Okay, simple measure, but it annoys cash flow. Okay, so it's not a good method. It annoys the time value of money. So let's look at this. A project requires upfront 500K with no residual value, means you cannot sell the thing again. Let's say you buy a machine 500K. After using it, there's no scrap value. If there's a scrap value, we have to consider. But anyway, this example is no scrap value. The payback period has a maximum of 3 years. The company expects the following cash flow. So year 1, year 2, year 3, year 4, year 5. This is the positive cash flow. What is the payback period? Step year 1, year 5 amount. Okay. Initial investment is 500K. Sum of year 1 to year 4 is 450. Therefore, you still got balance of 50K. This 50K divided by 125 times 12 equals to 0.4 times 12 will come back to 4. You can go to month or you can just divide. No need to times 12. So it's actually 4.4 years. That means this is the payback. But if you want the payback to be 3 years, you fail. Okay, you fail. Okay, let's look at the figure. 100, 150, 150, 50, 125. Okay, somebody remember this figure? Huh? 100, is it shown here? No. 100, 150, 50, 125. Okay. Let's go here again. We use the same example. This is not important. Okay. You're talking about 500K. Minus 500K. Hey, what's the next one? Can you remember or not? 100, 150, 150. All keep quiet, huh? 150. Hey, 100 first,
100, 150, sir.
150. What else? Cannot remember.
And 150 again.
Yeah, then?
150.
Sure or not, you?
Yeah, 50
50,
and then
125.
125.
Okay, 50, 125, huh? Okay, so we make a profit of about 75. So it looks okay, correct? Right? Now, if here is 100, what is the payback? So, plus this. Okay, that means what? 400K. Minus this. Okay, something wrong with the formula. C5. Oh, wrong. Plus this. Minus. Does it work? Oh, cannot because it starts with a minus sign. How does it work? The other way around. Minus. I'm not sure. Just hang on. Hey, still cannot. I don't know how to use this formula already. I just put like this lah. 500K minus this one. Can? Cannot. Ooh, why cannot? Hang on. Should be like this one. Plus this minus this. Ooh. I don't know how to do Excel formula also. So 500K, 100K, okay, that's 400K lah. It should be minus 400K. Oh, C5 lah. Plus lah. Oh yeah, okay, plus. Okay, still minus, huh? Then we do next one. Plus this. Oh, come on. This one is what? Plus this. Plus this. Okay? Understand? Plus this. Plus this. And here, plus this. Plus. Okay? So the last one, obviously. Okay? So here already add about this. If we give you a total of 800K, no. It cannot add up. So you minus out 100K. So you're still here. So it will be around 4 years something. Correct? 4 years something. Because here you only need to have another 50K to pay, right? So you have another 50K to pay. Okay, and therefore here 50 minus divided by 125 will be 0.4. That's why you got 4.4. You understand? So here, when did we finish? We finish at 4.4 year. And therefore, we have made a profit of 0.6 year. Only this is 0.6 year in the 5th year of profit. Okay, so how much is this? 0.6. Oh my God. 0.6 times. Oh, I have to put a formula first one. Equal. Do you see? Okay, that's what it means. So when you look at payback, it's easy to explain. Okay, we're going to spend 500K and then every year we're going to get 100, 125, 150 or whatever, 25. Oh, okay, we will pay back by 4.4 years. Only in the last year, we will get 0.6. Why 0.6? 0.4 here, 0.6 here is at 1 year. 0.4 plus 0.6 at 1 year, right? So the 6th year, only 0.6 year of in the 5th year is equal to 75. You can see the formula. So far, understand. So now let's little bit different. Let's change the figure now. Okay. So let's say we get 125,000, right? 100, and we get how much is that just now? 150, 150. Is it? Okay. But if you look carefully, if that's the case, the formula change. So at the end of 1 is 375, 22575. Okay, therefore, we only need to pay here last year 75. Now, 75 is equal to balance. This 75 is equal to 0.5 years. And therefore, we're going to earn 0.5 in the 5th year, which is equivalent to 0.5, 75. So the grand total in terms of accounting profit is still 75. But in terms of payback, is different. One is 4.4 years and one is 4.5 years. Which is better? Of course, the shorter term is better. We can get back our money faster, will be lower risk. This does not consider cash flow, time value of money. It only considers cash flow without time value. So this is very much different from MPV. Okay, it's very, very much different from MPV. If you come to MPV, the figure may be entirely different. It can even be a minus sign. So sometimes you may have accounting profit, but because of MPV, right? So let's say, for example, we don't collect nothing. For example, what happens if we collect nothing? And here we collect you think it's 75. But because you only collect at the end of the year, the interest will be very, very much different. Time value of money is different. It will be a minus sign, even though accounting period show plus sign. Okay, so my best suggestion for you is when you're doing comparison. Now, in the hospitality industry, you will have a lot of investment opportunity and you don't have enough money. So you have to consider which is the best use of your money, which is the best various alternative, right? Somebody say want to buy an MRI, somebody say want to buy a lung machine, mechanical lung machine, somebody want to buy maybe a X-ray machine, and somebody say want to set up a new clinic, whatever it is, right? So you got various alternatives and you got limited amount. You cannot do all. Then best way is to look at NPV. Okay, payback is easy to understand. So sometimes what we accounting people do is we calculate the NPV, we already know which is better, and then we calculate the payback, and then once we calculate payback, we may present payback, we will not present NPV. Okay, because NPV is difficult to understand. This is easy for understand. Okay, payback. Now the other one is called the PI, profit index. Very simple. Take the present value of future cash flow divided by the initial investment. So all the present value divided by greater than 1, okay, except equal, indifferent, less than 1. Okay. So let's look at the amount. So you got project A, project B, project C. This is the present value. What is the present value? Here. Do you remember the present value? All this amount, add up all this amount divided by the initial amount. Okay, this amount divided by the initial amount. That's all. Okay, this is just for understanding only. More than 1 better, less than 1 not so good. Okay, so you got maybe different investment. Okay, 125, 200, 150, and the present value is different. And if you just minus it, it looks that project B is the biggest, right? Project B is the biggest. Okay, but when you look at percentage, 150 divided by 125. Okay. Then 238 divided by 200 and 182 divided by 5. You will see the figure. The higher figure is this one, project C, even though the present value is this one. So now you come to a dilemma. Which one should I use? Should I use this amount or should I use the percentage? Many cases, we use the amount. Okay, we use the amount. Now, why is this important to understand is look at the investment amount. You see, 150 investment is lower than 200. Of course, maybe you give more investment, you get more return. Here you get less investment, you get maybe lesser return. So as far as return is concerned, this is the best. But sometimes you don't have 200, you only got 170. If you got only 170 to invest, then you cannot invest this 200. You might invest it on 150. Right? So it depends. If you got extra money in your company or you can borrow money, then you invest the 200. If you don't have enough money, then you're going to go and use 150. Okay? And you justify it because of the ratio is better. That's the best explanation. Do we present this one to management? Sometimes don't. Again, NPV, profitability index, IRR is difficult to explain to non-financial people. Okay? So sometimes we use the payback. Okay, it may not be the best, but we already calculated ourselves and we already know which is the best, so we can recommend. Now, third one, capital project selection in the hospital. Which project we want to settle? Now, earlier, second subtopic, we're talking about investment criteria using how much you invest and using the cash flow. But I want to say this is only one method of evaluation. There may be other things that you need to consider. It's not just profit. Does it fit your mission? Let's say your hospital is good for leprosy or TB, tuberculosis. Okay, maybe X-ray machine is important for you, even though the MPV is not there. Okay, MRI maybe is very good making profit, but it does not suit your mission for TB, right? So you have to consider things like mission fitting. You have to consider things like growth strategy. Okay, does it, by buying this machine, does it support your company in the future? And also reputation. Sometimes we buy expensive machine, even though it cannot make so good MPV, but we want to be well known that we have the latest machine. Okay, so strategic alignment filter is important, not only just the MPV numbers. Okay, then sometimes there are law. Okay, the hospital to follow certain law. When the law change, okay, whatever you calculate in MPV, it shows you are positive, but when the law change, okay, maybe the law suddenly change, say we cannot use MRI because of radiation or something like that. Well, sorry, you cannot buy this kind of machines. Okay. Clinical quality link. Okay. So this is called how to avoid penalties and how to improve your margins. Okay. So this is what example, reduce CMS penalty. Okay. This CMS penalty means the government will penalize you if you do something. Okay. Maybe when you do investment, okay, it can lower infection rates, reduce cost and length of stay. You do not want to have a patient to have a second type of disease coming in, okay, and translate the quality gain into good profit. So this is investment in quality can be very advantage for you, even though the MPV is sometimes even negative. Okay, maybe sometimes even negative, we will still do the capital investment because it increases our quality. Okay, some machine you buy, even though it's not making profit, but you have to because it's a law. Okay, if you don't buy, then you have a problem. Okay, cost of capital for non-profit. So now, what about non-profit hospital, government hospital? Now they don't have shareholders, so they're not worried about profit money. So for that kind of public hospital, they're not going to be interested in MPV. Maybe they're interested in how to serve the society or how to serve the community. So they do not use financial calculation to justify any type of capital investment. Okay. Now there are many ways of scoring, which is need to be explained now. Like I say, financial MPV maybe can 30% of your thinking, decision making. Fit another 25%, risk another 5%, maybe community another 20%. So when you look at a project, okay, project A and project B. Project A, what is the financial MPV? A and B. Oh, A is good. Doesn't mean straight away you go A. It should only cover up to 30% of your thinking. The next one, strategy fit. Same project A and B, which will give you a better fit. Maybe A give you a better fit, so you get the 20 marks to there. So what it means is like that. So you have the A, B, C, and D, right? And here is 30 marks. I think here is 20 mark. Where is it? I'm getting old already. 30, 25, 25, 30. 20. Okay. So maybe MRI, okay, it's very good. Okay. So hang on. You got MRI. What's the other one? X-ray. Okay, both also show positive because this one is based on the MPV one, right? This also show positive, so this is very good for MRI. This is not so good. You get 20 marks. Okay. Here is the total marks. Okay. Okay, then maybe the second one is fit, strategy fit. This one maximum 25. Okay lah, maybe we get 20, and maybe this is a better streak. So 25. Right. The next one is, I think, is risk. That's the next one. Yeah, risk and community benefit, for example. Okay, maybe this one is risk to the company. It has got very low risk. Okay, so maybe you can get 22. This one got in terms of risk profile, we have this X-ray machine will create problem for us. Maybe we only give 10. Possible give 10. And the other one is community service. Okay. MRI is very good, but only few people will use MRI, so we get 10. But X-ray, many people are using, so we give 20. So, okay. 82 is better, so we will use MRI. So when you do capital investment, you are not only looking at MPV. The MPV amount will determine the percentage here. Understand? Of course, it's good if you can get 100 and here 100, but it's very difficult. So this is your passing mark. Okay, this is your max mark for each category, and then you evaluate yourself. Now, how you evaluate is based on your judgment. As far as MPV is concerned, it is a mathematics. As far as fit risk community is art. You feel. Okay? Then at the end of the day, this percentage is actually hey, you all can see. I don't know whether you can see not. I didn't realize that. Okay. Class monitor, any question? Can you understand what I'm saying?
Yes, sir. We can see and we can clear about it, sir.
You can see about it, Adi, huh? Okay.
Yeah, just now
So,
we can see.
oh, okay. So when you talk about, I know this subject is accounting and finance, but in practical, the word is not all the time in accounting, right? You have to consider other things. Does it fit your mission? Is it risky? Level of risk? Okay, and does it serve the community? Okay, if it's less risky, okay, we give higher mark. More risky, we give lower mark. More MPV, you give better mark. Less MPV, you give lower mark. You understand? Okay, this fit our mission. This does not fit or lesser fit. So that's how you allocate the marks. It's as simple as that. So at the end of the day, maybe it's better to do MRI. Okay, maybe you do MRI. But let's say example. Okay, let's say example. This one was terrible. Okay. Now, if that's the case, if this is terrible marks for fit, so this should be better. MRI is better. But based on MPV, MRI is better. Based on grand total, X-ray is better. Understand? Okay? So do not just use MPV. You have to use more. Now, is it only subjected to 1, 2, 3, 4? No. You can have more, few more. You can inject a few more inside here to give a more holistic evaluation. So the word here is holistic. What does that mean? To put in more parameters so that you can view it bigger picture. You can get a bigger picture to do evaluation. Instead, only sticking to NPV. Understand? That will be the best way for you. Okay? Wait a minute. Hey, where am I now? Oh, battery. Why no battery? Wait. Hang on. Oh, I forgot to do charging. Hang on. Oh, okay. Oh, nearly died. Next one. Okay, risk analysis for long-term investment. What do you mean by long-term? We all normally say long-term is more than 1 year. But there are investments that may be for 20 years, 30 years. If you are buying an MRI machine, or maybe 5 years or 10 years, but if you are building a hospital building, 10-story high, right? This is really risky and really long-term. Okay, so for a long-term uncertainty, okay, so you need to do sensitivity testing. Okay, change one variable. Okay, what does that mean? For example, let's go to here again. Okay, oh, this is a very bad example. Okay, never mind. I do a new one. Where am I now? Okay, we say year. So you got year 0, 1, 2, 3, 4, 5. Example, okay? Now, your investment, maybe in the first year you invest, okay, this figure. Now, okay, you collect while using this machine, maybe you collect 200, 300, okay, 300 competitor coming in, so you cannot collect so many. Okay, maybe first year you can collect a lot of money. Okay, and then your expenses. So maybe you pay your expenses 300. Maybe now you become lesser expenses. You become more careful in your expenses. Okay. So your expenses is what? Okay. Your expenses is maybe the maintenance of the equipment. Okay. Most likely it's a maintenance, I guess. Nothing much now. Okay. Therefore, this is the cash flow. So what is the cash flow? Minus 1,000. And this one is basically plus this, minus this. This is the cash flow that we're talking about, which actually comes from what you collect and what you pay. Okay? So we're talking about this one. How do you get the cash flow? This is the one. So now you vary the input. This is what you think. Huh? Correct? So this is what you think. So, okay, let's say now we vary the input. Okay, maybe the expense will be increased by 1.5. Why? The amount will change because you do sensitivity testing. Initially, right, maybe it's 300, right? Therefore, you will have this bad. Let's say you invest, never mind. Okay, let's say you have here 500. Okay, and here you will collect maybe a 300. Okay, now, okay, let's look at this figure. Now it's 200, right? So now we do the same thing. We put it over here, right? Now the expenses is no more this amount. Okay, We will take this amount. Let's say we increase the expenses 1.05%. Copy this one down. Oi! Suddenly reduce because we have a 5% increase expenses. Okay, let's say for example, 5% still okay. What happens if we consider is 10%, the increase in expenses? Oh, still okay, positive. What happens if we increase it now to 20%? Hey, therefore, we can tolerate our expenses increasing by 20%. We cannot tolerate more because it's going to be zero here already. Accounting profit. If you look at MPV, it's even going to be worse. Correct? So that's what it means. So when we do like this, it's what was taught. But if you want to consider sensitivity, okay, if you want to consider sensitivity, I think our expenses cannot be more than 25%. Let me see.
Charged battery fully charged. Unplugged charger dot
Oh.
minute.
Maybe 30%. I don't know. Let's see. So if our expenses increase by 30%, we will get zero profit. So we have to control our costs. Cannot be increased by more than how many percent? 30%. Right? So we can do the other way around. What happens if our sales, can our sales drop by 10%? Oh God. If our sales drop, more than 10%, we are dead. Or expenses increase. That's how many? I think 30%, isn't it? 30%, we are dead. Okay? So even though you have done this one, and maybe you have done this one, and you are selected whichever way, okay? So whichever way you select, right? You need to do one more time that is called sensitivity testing. How much sales can drop? How much expenses must be increased before we kill ourselves? Of course, best way is follow exactly this one, right? But sometimes due to external factors, economy go down, so your sales will go down. Inflation go up, here comes the expenses go up. Simple as that. Okay? So far, can you understand what I'm saying? So when you vary the amount, their sensitivity, you have to recalculate your MPV and then identify the risk. Okay? So normally 10% or 20% down, one or the other. So far, under any question? Understand?
So far we
Angeline, where are
good,
you?
sir. So far we are good, sir.
Anybody got any question on this topic? No question? So we summarize. We have gone through the time value of money, means that money got value affected by time. Okay? Evaluation technique, I have teaching you the best one is net present value. You can also use the payback for the non-financial people. Then how do you select You must select your project not only based on the NPV, net present value. You should also consider strategic strategic fit, risk, and community service, because you guys are in the hospitality, hospital industry. Okay, and the last one, analyze based on sensitivity. Okay, because if you think it's possible that the sales can drop 10%, right? Therefore, initially looks very nice, but now you have a risk. Okay, the risk is very, very terrible. Okay, risk is very terrible. Even if 10% drop in sales, you will have a negative profit. Therefore, most likely a negative NPV, guarantee one. Okay, so do this kind of analysis. Okay, can we take a 5 minutes or 10 minutes break? Now it's 4:10. Okay, I will take oh, is it 4:10? 4:15? A short break. We come back at 4:20. Okay, Angeline, you hear what I say?
Okay,
Okay,
sir.
4:20, short break.
Okay,
Okay.
sir.
Okay, hello everybody. So let's continue, right? Can you all hear me?
Can, sir.
Okay. Now we go to funding, financing and funding. Now, there's a big difference between accounting and finance. Accounting means you're recording, okay? You're recording what happened in the past. Finance is different. Finance is where to get the money, how to spend the money, okay? So please don't get confused. Accounting and finance is different. We're going to study few things here. Sources of money, financing for your healthcare organization, which way, better to borrow debt or to increase your capital, share capital, which is called equity. And then maybe you can get some government subsidies, grants, and some donors, maybe some rich people who want to contribute to your hospital, giving you money. And you also would like to look at the public and private partnership in healthcare. Okay, so we start with the first one, sources of finance. Okay, there are many areas you can get money. Okay, now, first way is you generate yourself internally. Your hospital generate internally your own money. Okay, so where you get your money? Operating. Every day, patient come in, you see them, they give you money. That is called operating cash base. Patient fee, patient with the medical one or insurance, you get from the insurance company later on. Okay, maybe it's got some service contracts with company. Some company will appoint your hospital for annual health check for their employees and so forth. So these are where you get your operating cash flow. The word operating means it is your daily operation. Daily you do certain things, and that is the money that comes from your customer. Okay. Now, retained earnings is previous year's operating revenue. Previous years, you may have got some extra cash. That is the cash that you can use now. Unless the cash has been distributed out or by machines, therefore you don't have earlier cash. But if you have saved some money from earlier cash, you can draw your earlier year's cash for today usage. Okay, so these two, prime operating and retained from previous year, okay, this depends only on your own company to decide. You do not go to the bank to borrow money if you have enough operating. You do not go to the bank to borrow money if you have got retained previous year. So what does that? Go to the borrow money, interest. If you got enough operating and retained bank to borrow, you don't have the interest. That when you go to bank and borrow, you got a lot of questions. You pay back monthly, how much, how money they can give you as you want, and the payback period they will determine maybe 5 years or 6 years or 10 years or whatever it is. So that's the best way. It avoids external dependency. Okay, external dependency can be the bank. Okay, and can maintain control because these are your own funds. You can control how you want to spend it. Now, having said that, you better be efficient. You must have effective management of revenue. What does that mean? You're collecting from operating. Make sure patient pay you. Make sure the insurance company pay you. So you must do not delay collecting money, because that money is lifeblood of your hospital. Okay, so efficient billing, very fast must come on the bill. So sometimes in the hospital, when people stay there for a long time, they don't give you the bill at the end of your stay. Let's say, for example, you stay in 1 week. After 2 days, hey, please pay a little bit. 2 days, please pay a little bit. You know, then not enough, please top up. You know, that kind of efficient billing. And then if you're collecting from insurance company, some insurance company got code. Which code is collect which money? And then some of the code may have, for example, code 01, general doctor fee, code number 10, surgical fee. So you put the wrong code, insurance company will try to delay you. Now, why does insurance company want to delay you or don't pay you? The reason is because if the insurance company don't pay you, this is profit for them. If they delay payment for you, the insurance company take your money, that don't pay you now, delay you, the insurance company put the money in the bank, earn some small interest. Okay? It is in the interest, it's the behavior of insurance company not to pay you, if possible, or delay you. All this will be a cost to you, right? Now, you also got philanthropy, community capital, donations, rich people, foundations. Maybe a rich patient cured by you, so happy. Tomorrow he give you a check for 1 million. And then this 1 million, you will use it for your own hospital expenses, right? And you can call this as a Mr. A fund or whatever it is, okay? Not often. Philanthropy, not often. But if you have, it's good. Now, donors, they can deduct what they pay you for their own income tax. So let's say the donor had to pay 1 million income tax. He already considered he don't want to pay so much to the government. Maybe he'll donate some money to you, and his income tax payment will be reduced, not by the same exact amount. Let's say, for example, he donate to you 200K. In his tax bracket is maybe 20%. So he's going to save 20% on the 200K. So he saved 40K. So when he donate to you 200K, he saved 40K tax. The net he actually donate is 160 to him, to the donor cash flow. But to you, the hospital, you get 200. To the government get less than 40. Okay, that's how it works. Okay, so if you got good philanthropy, good. Now, in certain countries, like in US, they actually encourage the same group of people to donate every year. Small amount. But they ask them to donate small amount every year. So when you have a little bit here, little bit there, many people, all small amount, it can become a very big amount. Okay? And this one, sometimes have, sometimes don't have. So you cannot rely on this philanthropy money because it is uncertain. The timing and the amount. Maybe the amount can be very low or even zero. The timing can be 2 years from now, not now. Okay? Now, so that's why we have a thing called a sustaining giving cycle. Okay? Align donor intent with strategic priorities. Some rich fella, the doctor died because of TB or died because of throat cancer. They will donate for you to do research for throat cancer. Okay, so these are sustaining. Okay, hopefully best one is sustaining, even though small amount. Every time you have this kind of amount coming in. Now the next one is you go outside and borrow. That's the problem. Whenever you borrow money from the bank will take care of two things. First, how much you want to borrow? Do you qualify to borrow? To qualify to borrow, you have to show a good trend, historical trend that you are making good profit in the past. And you will continue making good profit in the future by They will ask you, what's your business plan for the future? What's the business plan for the future? For example, okay, I want to borrow money from the bank. I will make a new hospital building. You tell the bank, I want to make a new hospital building. They will tell you, okay, with your new hospital building, how much you can generate? Okay? What is your business plan? Sometimes you can even show them your MPV. You can show them your payback to convince them that the borrowing is for a good thing that you can make profit from. Because if you borrow and you cannot pay back, not only the principal amount, but also the interest, you think bank will lend to you. So they want to know, can you pay back and how much they can lend to you? Yeah, they have got various formulas, okay? Banks, bank by banks, individual banks, sometimes one bank to another bank, nearly same formula, sometimes little bit out, not so much, okay? The key is they want to know, can you pay back? Principal plus interest. Now, the second thing the bank will think about is you are not the only person looking for money. You, hospital A looking for money, hospital B looking for money. Maybe another business making shoe also want to borrow money. Another business maybe want to make car also want to borrow money. Maybe many individuals want to borrow money to buy houses. Okay? So many people are asking the bank to lend them money. How does the bank allocate? If every one of you can pay back, bank will lend to you, everyone. But the bank don't have enough money. Understand? So the bank will select the same way you select for investment. Now, how do you evaluate the investment? Which investment that you want to use? You use the MPV, the strategic fit, the risk and service to community for you on the hospital. For the bank, also got various investment alternatives. Lend to hospital A, lend to hospital B, or lend to a company who wants to make shoes. Maybe they're looking at MPV. They're also looking at their strategic fit. They're also looking at risk. The service one, maybe they don't look for banks. Now, what's the strategy fit for the bank? If I'm the bank and my name is Agro Bank, so I would like to lend to people, farmers. Okay, if I have no Agro Bank name, maybe I have a name like in Malaysia, Building Society Bank. Okay, so I will lend to under my strategy fit for housing. Or if I'm an import-export bank, in my name, in my mission is import-export, I will only lend to those people who do import and export, not necessarily a hospital. So depending, make sure you're going to the correct bank that is willing to listen to your loan proposal. So they will look at the strategy and then they will look at your risk. Can you pay back or not? They'll look at profit trend. They'll look at how much money you already borrow from other people, because you have to pay other people first. They also look at your cash flow. Do you have enough money for your running operations? Okay, and so forth. So there are a lot of commercial banks available. You can lend them from them. Okay, so you have, you go to get loans. It can be a term loan. Term loan means you borrow 1 million, you pay back 200K every year, you know. Okay, or revolving credit, you will borrow 1 million, but you don't use, you only use when you want to draw down. It's like, for example, an OD account, overdraft. Okay, now they will evaluate you. How good are you compared with another borrower? Then convenient compliance. You want to borrow 1 million? You know what they tell you? Okay, we don't give you 1 million. We give you 1 million, but you must put back 200K as a fixed deposit. Why? So the bank will charge you interest for 1 million. And when you put a 200K back deposit, it's very low interest rate. Why the bank wants you to keep back 200? Risk. They want to reduce their risk. They're not actually lending you 1 million. They only lend you 800K. Because they give you 1 million with the condition 200K, you don't use, you put back into the FD. So the loan is 1 million at 8%, and you put back 200K in FD, which is 1%. Either way, they make money. Okay, convenience, compliance, or they say you want to take 1 million. Okay, your another building is put under my name. If you don't pay, I will take the other land. Okay, it's convenience, compliance, collateral. Okay, detailed collateral schedule. Collateral schedule is as the loan. Okay, for example, bank lend you 1 million. Hey, 5 property, go under my bank's name. After you pay a little bit, become 4 property. You pay a little bit, become 3 property. So there's a collateral schedule. Okay, to reduce. Once you pay a little bit, lesser collateral is needed. So they return back certain collateral to you. Next one, bond market. What do you mean by bond market? Bond market is a hospital issuing a piece of paper to lenders, not necessarily to banks. It can be to individual, to other companies. And the letter say, okay, it's an IOU. I owe you piece of paper. Bank say, you lend me 100. After 1 year, I pay back to you 110. That is called a bond. Not common in Malaysia. Very, very common in, maybe for example, in USA. Like big companies like Ford Motor Company, okay, GM, General Motors, all of them issue bonds. The interest rate is a little bit higher. Why? You see, the government also issue bond. The government say, okay, I issue you a government bond, a treasury bill, got a name. You give the government 100 now, government promise to pay you back 110 1 year from now, 10% interest. The company also use the same idea, but there's a big difference. The government don't go bankrupt. The government tomorrow print some more money and pay you back. Understand? So therefore, the lenders feel lesser risk, so will take a lower interest rate. But you, a company issuing bond, even though you're a big company, you can go bankrupt. The company can go bankrupt, and then my money all gone. Right? Therefore, the bond for company is a higher rate. Now, it's very, very uncommon in Malaysia. Okay? First and foremost, we don't have so much money, okay, to lend to the bond. And secondly, our company sometimes is not that good to issue AAA class bonds. Okay? Now, bond issued by company need to be rated. In Malaysia, we have the rating agency of Malaysia, RAM. They will rate the bond, whether AAA, AA, or just B or C, which is a junk bond. Each type of bonds, the grading by the agency will determine to a certain extent the interest rate. AAA will have lower interest rate. Junk bond will have very high interest rate, okay, depending on risk. Okay, so but it's very uncommon, right, for company in Malaysia to issue bonds. Next one, alternate financing via sales and leaseback. Sale and leaseback, very simple. You have a building, you have a land, okay? You sell this land to a leasing company. I'm sorry. The leasing company give you cash. Now that land you have, maybe it's 10 million. They don't give you 10 million. They give you maybe 5-6 million cash. So the property that's worth 10 million is given to these people, and they give you 5-6 million, and you have to pay back the loan with a certain amount of interest, and after 10 years or whatever years, they will transfer back the land to your title, to your name. This has advantage over bank, because This can do very fast. You have a land title. They can do valuation very fast. Okay, very fast. They can do valuation. Compared to the bank, you have to give a lot of documents. And over there, the bank side, they do take time. So sometimes you mean immediate, you may want to have a sale and lease back. I sell you, lease means I rent it back from you. Renting back. Lease is something like a renting. I sell you the land, I sell you the building, okay, but I want to rent it back. So that's a contract. Okay, a sale and lease contract. So if you provided you pay everything, the thing come back to your name. Should you don't pay, the thing belongs to them. That's why for a 10 million, maybe they only give you 5-6 million. In case you don't pay, they sell. Maybe they sell at a very cheap price, but they can still make a profit. Okay. For rental, sales and lease, the rental amount is stated in the contract, so it's very predictable. This is equal to something like the rental fee will be inclusive of the amount to pay back plus a certain portion of the profit that the lease company wants to have. Okay. Now the balance sheet problem is now the land do not belong to you, so suddenly your asset is lower. So debt versus equity. Should you borrow or should you increase your share capital? Okay, I don't know whether are you going to study financial accounting, but maybe you're studying company law. I'm not too sure. They will teach you something about share capital. Okay, debt financing, whatever interest you pay to the debt, that interest payment is tax deductible from your income when you pay income tax. So it's not so bad. Okay, so but if you're getting money from your shareholders, whether current shareholder or new shareholders, you don't pay interest, no? How do you pay your shareholders? You pay by way of dividend. Now, what is dividend? Dividend is profit. So let's say for the company makes 1 million profit, they can pay 1 million dividend to their shareholders. They cannot pay more. It's against the law in Malaysia. You can only pay out of profit, dividend. You can pay less. So who determines the amount of dividend? Well, the board of directors propose a dividend to the shareholders in the annual general meeting. The shareholders will go to this meeting and do voting to accept 10%, 1 million, or whatever figure that is proposed as dividend, which must be not more than the profit. Now, if the shareholder think the profit is too little, the dividend is too little, they will ask the directors, hey, why are you holding so much money? The directors will have to say, oh, we're holding the money for future investment, and these are the plans, and these are our projections. The shareholder accept it, okay, we will accept a low dividend in the case of future bigger profit. If the shareholders don't agree, they want more dividend, so they will reject. And they get angry, they change the directors. Shareholders will now elect new directors which listen to the shareholders to have more dividend. Now, think carefully. The directors may not contribute money as capital for the business. Shareholders contribute money as a capital. So shareholders give money, but they do not control the money. How is it going to spend? Directors never contribute any money. Got money from shareholders and they're running the business. So in other words, shareholders is giving money to somebody else to use their money. Understand? Now, so if shareholders are no good, directors no good, so directors will eat the money, and then we have another case of a police case. So every year the accounts need to be audited to show that how is the company is being run. It's audited by external auditors to see the accounts is correctly done. Okay, so when You have this thing called the agency problem. Shareholders contribute money, but they don't use the money to run the business. They have no say. Directors don't contribute money, but they got the money from shareholders to run. Free money. Right? So, if there is a profit, shareholders were thinking, why we give so much money to the directors? Why are we not using our money give back to us as a dividend? So this is called the agency problem. So therefore, many companies would like to give more dividends, unless some company have got a plan, okay, not to use up all the excess money, to reserve some money for future investment. Now, here comes the next one, which is called the average weighted cost. Now, if you remember, just now we talked about the NPV, and we use a discount interest rate. That discount interest rate can be the rate that you borrow money from the bank. It can be also the cost of the capital. What is the cost of capital? For example, what's the cost of dividend? So the cost of dividend, okay, can be the cost of capital. Okay, so you're using the cost of dividend, let's say 2% or 3%, as the interest rate when you calculate your NPV. Normally, we will use a higher percentage. Okay, one of the best one is to actually use the rate that the bank will be lending to you. Let's say you don't borrow money from the bank. You got enough money. Use a theoretical bank loan rate for the NTV calculation. Okay, now, project valuability. What does that mean? When you're doing investment, should we borrow money or should we use equity, share capital? Best is to use equity because it is free. You don't have to pay interest. You understand? It's free in the sense that you don't pay interest, but it's not free in the sense that you have to pay dividend. But dividend can still negotiate with the shareholders. Not so bad. Okay, bank loan is one signed contract, there's the interest. Okay, so in many cases, if you have to borrow money from the bank, is not the best solution. Best solution is to get money from your share capital. I think the best one is get money from your own operation profit. Second one is equity. Third one is debt. Okay. Now, leverage ratio, if you borrow a lot of money from the bank, shareholders will get nervous. Suppliers going to get nervous because you have to pay money back to the bank. Okay, your employees will get nervous because you have to pay a lot of money. They have no money for your salary. Shareholders get nervous if you borrow a lot of money from the bank because they will not get the dividend. All the money profit will be given to interest to the bank. So please remember the leverage ratios. Okay. Now, the other one is excessive equity. Some company have extra cash and they do not know what to do with it. Like for example, tobacco company. Okay, maybe for example, Benson Hedges, okay, or Rodman's or Miles 7. They are very rich company. They have so much cash because of selling of cigarettes, but they cannot invest in another business. They don't have the know-how, so they got excess cash. So this excess cash in theory should be given back to the shareholders as dividend. But sometimes they hold back. They are thinking of maybe moving to a new investment. Okay, so be careful of excess capital equity also. Loan agreement convenient. Convenient restrict additional borrowing. If you go to bank A and you lend money from bank A say, hey, don't lend any more money from other banks unless you pay me back first, you know, and so forth. So clinical expenditure, capital expenditure, even clinical service closure, or the bank say, well, you cannot simply close your clinics, okay, when you borrow my money, okay, and so forth. Okay, so there are a lot of negotiation terms to be involved. Timing, when the economy is very good, you got a lot of money, so sometimes you don't borrow money from the bank. It's when the timing is very bad, economy is very down, you don't have enough money, you borrow money. So when the economy is no good and you are not doing a lot of business, so you need to borrow money. And that is the most difficult time because the bank will now think you're not making profit. If I lend you money, maybe you bankrupt now. So when the economy is bad, it's even more difficult to borrow money. When the economy is good, when you don't want to borrow money, the bank come and see you. Hey, please borrow money because the bank need to make profit. By lending to you, the bank make profit. Okay, so depending on the timing. When you need money, the bank don't lend you money. When you don't need money, the bank will lend you money. That's the problem. Okay, hybrid convertible bonds. Some bonds can be converted to shares. Mandatory convertible preferred stock. Some stock. We have ordinary shares and preference shares. You can be converted to normal shares. Earnings before interest, tax, depreciation, and amortization. They are looking at this one. How much profit you are making before interest and before bank loan interest and before tax. This is your operating profit. They want to make sure that you are very successful before they lend to you. Government subsidies, okay. For example, in US, Federal 330, this is a grant by in the US side, okay. So they will give awards, okay, to qualified health center. Now, in Malaysia, Malaysian government don't give money to Asunta. That's it. Okay, but in US, they give money to private hospitals. Okay, I don't know, maybe for election purpose, voting purpose, grant. So they got some requirements, cover operational deficits. Okay, because US government do not want the citizen to suffer. So if you are sick, you have to go to hospital, and therefore, if you cannot pay, sometimes the government pay on your behalf, depending on your eligibility. Here in Malaysia, no such thing. You go private hospital, you pay 100% yourself. You have no money, you go to government hospital. That's all. Okay. In US, it's a bit of a mixture. Okay. You can still get grant. Okay. Biggest one is called the USA Medicaid. Now, this one already stopped recently. Okay. But if you come again, Medicaid is under President Obama many years already. Okay, it basically pay to the hospital. If you a patient, you go to hospital, you don't have enough money, some will be covered by Medicaid. Okay, now not so much. Okay, in US, unless the Democrat take over and start again the Medicaid. Okay. Health Resource Administration Rural Community Grants. This is given to a private hospital in the rural areas. Okay. Global Fund USA Emergency Plan for AIDS Relief Mechanism. This is some example. Okay, I just want to show you because to show you that other countries, they are actually doing very well. Government actually help their citizen in hospital. Therefore, hospital business in the US doing fine. Okay, doing fine. Matching ratios. Sometimes they match 1-to-1. Okay, they match co-finance. Okay, if the patient can pay 100, the government match one more 100. Okay, for US side. Okay, public-private hospital partnership. You have always thinking about government hospital or 100% private. Do they got sometimes mix? In Malaysia, here quite close, you have a MU. Okay, Malaysian University Hospital, that's the English word. Okay, or sometimes we used to call the word University Malaya. Okay, UN. Okay, now it is a university, but in the university they also got course for medicine, so people can go and study to become a doctor in MU. And at the same time, they also got a clinic, which is half government and half the university, half. So we got specialists that got certain hours from the government hospital go to the private clinic. The fees not expensive compared to private, more expensive compared with government hospital. So somewhere in between. They do it not only for medical, they do it for, I think, dental also what. Dental also what, this kind of thing. So it's one matter like it's not 100% government, it's not 100% private, it's somewhere in the center. Okay, so this is ability, payment structure, dispute orientation, and so forth. Okay, value for money quantification. Now, private hospital, we have a various type of steering committee. Okay, mix up of government people, private investors, clinicians, and civil society representatives. Okay, this group ensure comprehensive oversight and accountability on hospitality, the care. They will monitor the performance, how many patients you can see, how long is the patient waiting time, okay, and so forth. So this termination and handback provision. Now, sometimes the hospital will say, oh, wait. You are not following the contract, so you cannot get the free medical. Okay, so it's material breach, or sometimes the public hospital say we cannot take in so many more people, not enough beds. Okay, so there's all these termination triggers for public hospital. Okay, and so staff transfer mechanism, if we transfer staff from one area of the hospital to another area, there must be a correct mechanism, correct handover of jobs, that sort of things, handover of patient. Okay, so all this must be done correctly. Let's say, for example, you're working in a public hospital, you are in Kajang branch, and you are now going to be transferred to Penang branch. The handover of the patients is also very important. Okay. Diagnostic service, consultant investment, fee for scan payment. What's that? A state government partner with a radiological consortium to equip staff. Okay. Private partnership invest in the MRI and CT scan. Then the government maybe provide the doctors, or sometimes can be the other way around. So you can have a fee for scan payment way, and local staff will be trained on the new equipment. Okay. Scaling primary care network via public-private partnership. Okay, to increase more primary care. Okay, I hope you know what's primary care, what's secondary care. Okay, so future outlook policy, ESG, environment, sustainability, and governance. Okay, is how you dispose your needles. Okay, environment, sustainability. Are you doing any pollution things? Okay, governance. Do you have a code of conduct? Okay, that sort of things. Okay, future outlook and policy trend for all hospitals. Okay, so if you look at this chapter, basically, you're talking about you need money. So how are you going to finance it? You can finance it with loans, or you can finance it with share capital, or you can also finance it with your profit and the past current profit and past profit. Cheapest, best is the last one. Okay, you're financing your investment based on your own money. Okay, operating profit and what retained years profit. Second best one is go and get new shares. Okay, people to buy. So you need to convince them to buy your shares. The third one, go and borrow money outside. That you have to pay interest. Okay. I'm sorry. Okay, so this is the end of chapter 2. Okay, anything you'd like to ask me? Angeline.
Sir, yes. So far on regards topics, no, but on regard of exam later we will ask.
Okay, we'll talk about it later. We still got 1 more hour. So now we'll go to the last topic. Chapter 9, no more. Where's chapter 10? Okay. Sorry, I'm not feeling that well. Strategic financial management. Linking finance with healthcare strategy, financial sustainability, cost containment strategies, performance management framework, financial challenges. Okay. First, linking finance with healthcare strategy. Okay. First, data-driven decision. You must have got access to financial data. What is financial data? How much sales? What is the expense? How much was incurred? When was it incurred? To who was it incurred? From whom is it incurred? Okay? Why is it incurred? So all these are financial data and all relates to money. Therefore, your data must be, first, accurate data. Second, reliable data. I can rely on this data. Third, it must be relevant data. And fourth, it must be timely data. Now, what does that mean? Financial data must have these four things. For example, you are billing a patient. You want the billing to be on time, very fast, so you can bill it and collect money. You want the data to be relevant to that particular patient. You're not going to mix it up with another patient to give the other patient bill to this fellow. Okay? It must be reliable. It must be accurate. How many needles was used? What type of medicine was due? What bandages was given? What kind of medicine is given? What is the money about? How much is it? So it must be on time, accurate, relevant, and reliable. So that's what it means. Only with this kind of correct data, we can make decisions. For example, if we are seeing a lot of patients are paying for X-ray, maybe we can invest another X-ray machine. If we are seeing not many people using X-ray, some of the X-ray technicians maybe transfer to another department or another part of the hospital. So this is important. Okay, financial data is important for making strategic choice. Based on former historical data, we can project what is going to be the sales or expense in the future. And based on this projection, we may make decisions to build another factory, or we close, to build another hospital, or we close down one or two clinics. So these data are important. Okay, so then we need to align with our goals. Now, sometimes our goal, like I say, is not just only money. Maybe we will invest on MRI, even though now there's little demand. But our goal is that we want to show we have MRI to boost up the image of the hospital, right? So sometimes money is not the only goal. Okay, but you need to align. Even though MRI is not going to generate big money for us, okay, at least we don't want to make loss. So we need to align. So therefore, if you're going to buy MRI, do we buy outright, or we going to rent the MRI? And when you prove that it's no good, can we stop renting? So this is how you align financial with clinical goals. If the financial show very good, might as well you buy the MRI machine, right? No problem, right? But if you think you're not so sure about your financial profit, maybe you do rental. Now, what? Not your industry, the airline industry. Airline industry, most of the airlines are lease rental. because they are not, in their industry is very unclear. How many people will sit in your airlines, right? So most of the planes are renting. Does it apply to your hospital industry? Not so bad. But there may be certain cases whereby you want to do renting. Will you buy a land and build a new hospital building? Or will you rent the building? Depending whether you got enough money to buy the land. If you have no money, you must rent. Or you're not too sure about the profit, then you better rent. Okay? So that is what it means by aligning financial with the goals of the company. Strategic resource allocation. Now, every hospital only got limited amount of money. No hospital got unlimited money. I think the only person who got unlimited money is the government because they can print money. The rest of us cannot print money, right? So, hospital also have limited amount of money. So they need to know where to invest. So need to be very strategic, not only in terms of NPV, in terms of strategic fit, risk, and service to the community. Now, in the hospital industry, there's a thing called service to the community. It's not just only profit. Because I think if you know, all doctors must go and do the Hippocratic oath, isn't it? Okay, save life and that sort of things. Okay. And then the last one, we have to consider long-term financial planning for the hospital. Okay. We do not want hospital open one day, next year close down. Okay. So you need to do a lot of planning. One of the best way is to have annual budgets. Now, how do you make budget? I think most of you are familiar if you are working before how you make budget. Now, here comes the trick. The CEO wake up in the morning. I want to increase profit by 10%. Okay, X-ray department, pharmacy department, emergency ward department, blood test department. What that one? Operating theater department. Hey, you guys are thinking how to increase sales, because I want sales to increase by 10%. So then you guys make the budget. You make your income budget and you make your expense budget. And then we add up all this. Oh, do we increase our profit? If no, okay, revise, remake your budget, redo your budget until it comes. Because the CEO wake up in the morning and say he wants to increase profit by 10%. Why? Because the CEO look at competitor profit going up. Or the CEO yesterday go for dinner, somebody tell him 10% is a very nice figure. That's the wrong way to make budget. The correct way to make budget is, what are the opportunities the correct way to make budget is this way. For external environment, you need to check what is the external environment and you need to check your internal environment. Under external external environment, you look at the opportunity that is available and you look at the threats that is available. And internal, you look at your strength and you look at your weakness. Okay, let's say now you're in a hospital. Let's say, for example, now you're in Japan. Okay, what is the opportunity? Oh, a lot of old people. Okay, so a lot of old people down there is opportunity for you guys because a lot of them will be sick and then go and see doctor, right? Go to hospital. What is the threat? Maybe the government have new tax, maybe SST tax, for example, sales and service tax. What is the internal strength? And in our hospital, our internal strength is, oh, we have got good doctors. What is our weakness? No good nurses. Now, if you are looking at these kind of things, this may be a few opportunity, a few trend. What should you be doing? You got a lot of old people and you got a lot of good doctors. So we will now try to say our hospital, okay, our hospital will treat more old people and convince them to come because we have good doctors. Okay. So now this is our objective. Now let's look at it now. How does marketing now do their budget? Maybe advertise in old people magazine, or maybe advertise through advertise in old people magazine. Maybe your marketing need to advertise through word of mouth. So if you are a former patient, you become very good already, we pay you some money, go and tell all your other old friends, please come here. Okay. This is what the marketing should be budgeting. Okay. Now, what about if you are old people, isn't it? Okay. So now maybe you are old people got a lot of sickness. Okay, MRI. So an MRI department. So what should you do? Okay, so you maybe consider lower MRI fees for old people. And young people, same fee, only old people. Okay, what about blood test department? A lot of old people, they're scared of injection. Okay, find ways. Do not do injection. And so forth. So every department must think of ways to do this one based on this one. That's how you make your budget. You don't make budget based on, oh, last year we got we spent 10K, so this year also we spend already a little bit higher, like 11K, or a little bit lower, like 9K. That is the wrong way to do budget. The correct way to do budget is to all the various departments must follow this one. And this one comes from this one. So if this one is wrong, this will be wrong, and various activity will be wrong. Why I use the word activities? Because it is with budget. Your budget is money. With that money, you're supposed to do activities. And that activity must be tied back to here, which tied back to here. So now, your budgeting is not depending on you, the department thinking what to do. Your budgeting is actually depending on the company decided what to do. So what is the company deciding what to do is based on external and internal environment. Do you understand this?
Yes, sir.
Angeline,
Yes, sir.
that's how you make budget. Don't care which industry you are in. The key point is to identify the opportunity and threats. Where am I now? You know? Okay, if you are not in Japan, if you are in Indonesia, what happened in Indonesia? Okay, these are a lot of young people. Okay, what's the threat? Many young people. So if you got many young people, it's a threat because they don't get sick. What's the opportunity? Maybe you have no opportunity. You're just a normal hospital. Your strength, maybe you got some strength here or whatever weakness, but the threat is maybe too many young people. So if that's the case, you as a hospital, you have too many young people in your country, Indonesia, very few old people. What are you going to do? You have to think carefully. Maybe because of this threat of young people, right? So you better have your strength. Okay? Get sports medicine. Doctors. Okay? Maybe you have no weakness or maybe you got some weakness. But can you understand? So if that is the thing, therefore your corporate goals is to get more sport medicine. This fellow, the marketing will be advertising in the sport magazine, right? Maybe you don't buy any MRI. Okay, maybe you're concentrating on healthcare screening, or maybe impact injury. Thought of doctors must be coming here. Okay, so this is an extreme example of Japan or Indonesia, or it can be many types. Okay, maybe you are you're a hospital that specializes in throat cancer. But if there is no people having throat cancer, you cannot do your good budgeting. You cannot have a good business. You may have to change your business from a throat specialist hospital, maybe to stomach cancer, because everybody eating I don't know, Korean, what you call that one? Korean cabbage one. Okay. So therefore, so you need to do that. It is the top tier people who must identify this without bias, clear identification. They must have their antenna up. The top people, the senior people must have their antenna up to know what is going on. Do this correctly, and ask all the various departments to do their planning to achieve this one. And in whatever action in their planning, you need money. That is the budget. Understand? And the problem is, this thing keep on changing. Especially the external. Government come in, new law. Or suddenly COVID comes in. Right? Suddenly Iran war comes in. Oh, this keep on changing. This one maybe not so much changing. Okay, maybe you can still control because within your internal company control. This is you cannot control. Okay, so whenever this changing, this may change. And this individual department, the actions will change. So then the reason is, how often should we change our budget? Whenever there is a drastic change. So normally we will have 1 year budget, first half and second half, January to June. Okay? Yeah, July to December. And then come to March or April, we revise the second half. Okay? So that's how we do because of changes. Now, whenever you revise the budget, it's because of changes, or maybe because you make a mistake in the budget. Therefore, you need to change. Okay? So, where am I now? So, it's chapter 8. Hang on. So, you need to do some planning. Sometimes can be 5-year capital plan. Now, why is capital plan 5 years? What's capital plan? Big items, hospital, okay? Building, land, okay? Very expensive equipment, okay? This can be, you need to synchronize. So you need to do your cash forecast. When you have a budget, So departments got expenses budget, and maybe you also have a budget for revenue, for sales. So month by month, you need to compare. Certain months you don't have enough money, you need to go to bank and borrow. So if now is March and you're planning for April to next year March, and you do month by month, and you find in June you have not enough money, you need to now plan to go to your bank to ask money for July. Because if in July you got no money, you go to ask, you think the bank can approve you so fast? Right? So you need to apply now. That's why when you're doing budget, you're doing monthly budget. Okay. Some cases even weekly budget. In factory, production is a weekly budget. Okay. So in your way, maybe it's not so bad, maybe it's a monthly budget. Okay. So some months you spend more, some months you get lesser money, right? And if that's the case, you look at your cash forecast, okay, the income expense over every month, your forecast. Certain month no good, you need to go and get ready to see the bank ahead of time to borrow money. Okay, so 5-year plan, okay, and so forth. Value-based contract readiness, shifting from fee for service to value-based contract demands upfront actuarial modeling. Okay, what does that mean? Now, fee for service is very simple. Okay, fee for service is very simple. You come, you sick, you pay. That's all. What about value-based contracts? Value-based contract is they haven't come yet, but you already got a contract with them, with the company. So the company got let's say, for example, a contract to send their people to come and see you in the hospital. Okay, and there's a certain amount of money they will pay you each time they come. Okay, so you may have to buy the equipment now first. Okay, so you may have to spend the money first to buy the equipment for the employees of that company to come one by one in the future. Okay, so which way is better is it's up to you. Okay, risk management. You have to consider risk. Like for example, just now I showed the example. If sales drop 10%, you are dead. Expenses increase by 30%, you are dead. So you need to know where is the gap, where is the problem. So month by month, when you compare, your sales is dropping by 10%. Oh, you better do something. So next month you must increase by 10% to recover. For example, January your sales drop 10%. February you may need to consider to increase 10% to recover your loss in January. That's what it means. Okay. Oh, this is nearly the same. Capital stewardship governance tier approach metrics. So you may have a routine replacement. Okay. For example, if very routine for you to spend certain money, so maybe so for example, every 3 years you must change your ambulance. So it's this routine amount not so huge. Okay, COE can approve. But there's a certain amount that's very huge. Want to buy a new building, the CEO cannot approve. Must go to the board of directors to get approval. So what you need to do is to make a table. Who can approve up to what limit or what they can approve. Like for example, there is money. Beside money can be anything. Promotion. Promotion of part-timer doctors to become full-timer, full-time doctors, or part-time nurse to become full-time nurse. Who is supposed to approve? Changing of medicine suppliers. Who's supposed to approve? Okay. Introduction of new medicine supplier. Who is supposed to approve? Cutting off of current medicine supplier. Who is supposed to approve? Yes, all these things. Okay, or investment decision. Who is supposed to approve? All these kind of things need to have a metrics table. Okay, so that it's very clear who can do what and what. I'll give you an example. Okay, hang on. Okay, we call it a decision-making authority. So management committee, board of directors, managing director, sector head, something like a general manager. So acquisition of land building, what limit, who is going to approve, right? Asset write-off, income, contract quotation. So you make a table and get this one to be approved by higher management so that everybody can follow when they do the actual spending. Okay, they will not overspend or underspend or something like that. Okay, you can make a table like that. We call it the approval authorization. Okay. So risk-adjusted decision criteria, not so. This is a score chart, balanced score chart. Okay, so you can blend your IRR with clinical outcome, beta, regulatory risk. This, I think, is too complicating. Is there an example or not? I don't think so. I think I write wrongly for you. It's too complicating, this one. Basically, if you move 10% of your sales go up and go down, you will understand the risk. Or your expenses go up and go down by 5 or 10%, you will reach a risk. So you can make a matrix, okay, of this risk. Scenario based, what happened? This one is for investment. This is a very famous Monte Carlo model. So you can stimulate pandemic, recession, policy shock against service mix. So you can also quantify your break-even sales point, condition plan. So all this, you can actually buy software to do this Monte Carlo model for your hospital. Now, at your level right now, we are not doing very detailed capital investment. So just know that you have this kind of thinking, okay, this kind of models that you can use. Contingency planning. What happened? Hospital on fire. You need to have a contingency planning. Okay, so you may need to reserve money. If suddenly there's a shutdown in one part of your hospital, because you may have to subcon out your services, and that will be expensive if you can find. Okay, so that's called contingency planning. Okay, financial certainty, cost containment, zero-based budgeting. When you start your budgeting, you start with no thinking. Like last year I can spend 10K. Why this year also my I spend 10K. Last year I can get 1,000 patients. This year also I can get 1,000 patients. No. When you do budgeting, we are looking at zero base. Start from the base as if first day of business. Okay. There will be more useful. Lean revenue design thing. Clinical variation, comparative dashboard. You rank surgeon implant spend per DRG. Peer-to-peer review, standardized best value, cost reduction strategy for improving best value devices, medicine, or supply costs. Those are all the various reduction facility. Outsourcing, non-core services. Okay, laundry. Okay, for the hospital bed, dietary, canteen, IT infrastructure, outside IT people, sometimes also ambulance services. This can be outsourced. Okay, why you want to do outsourcing? Because you are not the expert, right? So must I get somebody to do it? And you do not want to have those people under your headcount. When you have people under your headcount, you have to take care of their social welfare, yearly salary increment, that sort of things, right? So you only want to have core people like doctor, nurses, okay, surgeons, medical technicians, and so forth. That relates to patient care. Not directly related to patient care, you should subcon out, right? Subcon out washing or laundry. You're not going to buy your washing machine and a dryer machine in the hospital. Better not. You're not the expert. You get yourself in trouble. You do more unnecessary work. Okay. Dietary, canteen, food, and okay. These are some of them. Outsourcing. Green hospital cost saving. LED retrofit, reprocess, device reuse, HVAC optimization, cut energy, and this kind of thing. Sustainable design such as LED retrofit. I think you know what's LED. The normal white color one, change it to LED. Expensive one time, but no, in the long run, it's better for you. It's very safe on the electricity usage. Okay, we are talking about the lamps and the lights and LED. Okay, philanthropy and social impact bonds, target campaign. Okay, you can target. No, sometimes some hospital got a annual philanthropy dinner. They invite the rich people once a year, okay, and then have a dinner, maybe $10,000 per plate. No, that's all for dinner. So they sit down, they eat, and then you charge them very expensive. That is part of the philanthropy. Okay, get all the social network involved so that the rich people will feel important because they will be photographed, will be in the news, and so forth. Okay. Performance measurement framework, there are going to be a lot. Balanced scorecard, patient-centric approach, continuous improvement approach, KPI alignment. Now, what is KPI? Key Performance Index. Where did it come from? It comes from the budgeting time. So in the budgeting, in marketing, say they want to target the older people, advertise. So, did they do it? How much money was spent on the advertising for old people? And what is the number of old people coming in to the hospital? That is the KPI. Okay. So it can be many things. So your KPI should be based on your budget because your budget is money supposed to be based on your activities. And your activities as a department should be based on the company activities, goals. And your company goals is based on the external and internal environment. It flows all the way. Okay, so you need to check once they make the budget ready, based on this budget, what are your actions? And your action must tie back to the corporate goals. And these actions, okay, what's the deadline? And we'll measure the actual versus the budget. Okay, something like that. Okay, so your KPI cannot just only be money. It will be based on performance or activities related to the budget. Don't have KPI that is not the same as the budget. Okay, they are in sync, must be in sync. Okay, retail value, unit productivity, not so much. Real-time financial dashboard, cloud-based, not so important. Financial challenges in digital health transformation. Okay, this is the last part. Hang on. Capital intensity, modernization. Okay, so epic upgrades, optimization cost. Okay, a lot of hospital need to be upgraded, so it's going to cost a lot of money. Okay, so you need to hit the money. You need to monetizing. You need to have data to know how to get money. Okay, now in America you have this called ACO. Okay, but in Malaysia we don't have, unfortunately, so you don't do this kind of bonus. Okay, this kind of bonus you have to do your own. Okay, and then important thing is don't get sued for malpractice, because when your patient die or very sick or whatever, they sue your hospital, right? Now, your doctors are working for you. You are the employer, the doctors is your employee. When the employee do something very seriously wrong, you are in charge. You pay when patients sue you. If you cannot pay, then the patient sue the doctor. But the patient don't want to sue the doctor because doctor don't have so much money. You, the company, have more money. So patient always sue you. Okay, as a company. So you better be careful. Can you buy insurance? Yes. There's an insurance called professional indemnity, but they only pay if your doctor don't do anything wrong. Okay? As not negligent. That means the doctor is not negligent. You know, so the word negligent. Negligent means they're not careful. The doctor not careful, did something wrong. Okay? So if the doctor put the scissors inside the body after the operation, during the operation, the doctor went and put the scissors inside the body. Crazy. Okay? And then the patient go back home and the burger die because those scissors is still inside the body. Now, this is called negligence because the doctor doesn't take enough care to count the equipment before doing the sewing of the body after the operation. So now the patient, father, mother sue the hospital. Now the hospital had to show we have give proper training to the doctors. And the doctors have been trained not to put in the scissors. Okay, so hospital will pay after insurance pay hospital. So hospital consider insurance, hey, pay. Insurance say, hey, this is negligent. Hospital say, oh, we give them the training already. Then insurance say, oh, sorry, we cannot pay. Then the patient have to sue the doctor. Okay, because the doctor has been trained not to put the scissors. And he still do it. So the doctor had to pay. Okay, so that is called malpractice. And it can be very expensive. Okay, very, very expensive. Anything more? Cyber security, all your information. In Malaysia, we have a Personal Data Protection Act, right? All this information you cannot simply let out. Okay. Anything else? ROI machine. Okay. Hey, I think you all know what is sepsis. Sepsis is when the patient got a virus, got a bacteria. So the body come out, maybe white blood cell to kill the virus. And then the body get confused. They thought the white blood is also a virus. So therefore, the body overreact to the bad virus and also to the white blood cell defensive mechanism. And when the body overreact, organs start to malfunction. Blood may not go to the limbs. So sepsis is very, very dangerous. Severe cases can be as high as 90% people die. Not so serious, sometimes even 10% people die. On average, you get sepsis, 50% people die. Okay? And it's because of the body overreaction. Now, why does the body overreact? Not sure. Okay? Maybe because of DNA, because of some sort of trigger, they're still not sure. It's just that individual person, one person got cold, he take medicine, he recover. Another person, for whatever reason, he got sepsis. Okay? So, you, hospital, receive patient. They comes in, maybe they're in an accident or they got infection. Even the accident also, maybe they already got some bacteria inside down there already. If you think temperature keep on going up and you find that the body is overreacting, you have a case of sepsis and it is very, very fast dying. Now just imagine, why does private hospital, when the patient is going to die, they send it to the public hospital? They don't want the name to be bad. And they say, oh, we don't have enough doctors or we don't have enough medicine, faster, faster ambulance, send it to the public hospital. Because if they die in the government hospital, okay, well, it's not me, okay, it's not my private hospital. So this is, I think sepsis is very, very fast and very, very die very fast. So therefore, some hospital, especially in the US, they are using machine learning prediction whether you have a sepsis condition or not. If you have a sepsis condition coming, they faster wash their hand away. Okay, better wash your hand away. Okay. Software as a service, okay, cloud migration, your so much data, not enough space in your machine, so you're going to put it into cloud. Okay, so cash flow coverage ratio, okay, you have to improve your, I think I teach you already earlier classes, net asset ratio, asset ratio, working capital ratio, all this must be done very carefully. Debt covenant renegotiation, so you may need to renegotiate on your debt contracts. Okay, other than that, well, nothing. This is the last one. Digital divide, equity cost, low income population like broadband or devices. So hospital subsidized tablet or data plan to meet community benefits. These are not really for us. These are maybe for African countries. Okay, but they don't have much IT one. Community benefit requirement. Okay. By subsidizing technology for low income population, hopefully, you know, some not often, okay. Some hospital in the US, if you say that you're low income, they even waive all the bills. But they got a quota, and you must fit their requirement. Maybe a certain age or certain religion. Okay, it depends hospital by hospital. Okay, if your income is low and you tell them you're low and they found they're low and you fill other criteria, okay, then you can even get free. In Malaysia, well, no such thing. Okay, no such thing. So anyway, financial management. I want to wind up this one, right? So these are the 4 things you have to be very careful when you do financial management. Okay, do you have any questions so far?
No, sir.
Okay,
So far, we
okay,
are
just wait. Just wait. I want to take the 22 people in already. Hang on. I just want to take the attendance. Yeah, because it's important. Where is it? Okay. Okay, everybody.